In the alternate version of exercise 12-7, we're asked to prepare this company's cash flow from investing activities. Recall from your chapter, largely investing activities look at the cash impact of long-term assets. So if we're buying or selling pieces of plant assets, for example, equipment, land, building, those types of items, also long-term notes receivable and also long-term investments. Maybe perhaps we own stock in another company. Now, I'm not talking about common stock because that represents shareholder ownership in your own company. I'm talking about maybe perhaps we bought stock in another company. Now, in this video, I'm not going to go thoroughly through it, but keep in mind there's some exceptions. There's some non-operating current assets that may perhaps still fit within this category, so make sure you've thoroughly reviewed your chapter. Let's go ahead and delve in. Now, I'm going to go one by one and figure out first, does that item impact investing activities? And if it does, what's the cash impact of that? The first line item we have is an equipment with a book value of $82,000. An original cost of $166,000 was sold at a loss of $34,000. So we have a sale of equipment. Equipment is a long-term asset, so it needs to be factored into our investing section. Keep in mind we're receiving cash, but they've been a little tricky here. They didn't directly give us the cash amount. So we've got some problems here. Now you might think, I'm going to throw my hands up. This is the first line item. I can't work through this problem, but they've given you enough information. Think about the concepts you've learned in past chapters and build upon that in order to solve for the amount of cash. So let's think about this. And not that you have to record the journal entry a second time. It's already been recorded when this company sold this equipment, but recreating the journal entry can sometimes help you back into what the cash impact is. So let's go ahead and do that. Now we sold equipment. Keep in mind we have to remove everything related to the equipment on the books. So we've got to credit the asset account equipment for its cost of $166,000. We also need to debit accumulated depreciation. Accumulated depreciation is a contra account. It currently was on the books. We need to remove it by debiting it. The trick is it doesn't give us that amount either. So you might start thinking, oh no, now I had one amount I was missing cash. Now I have a second one. We don't seem to be going in the right direction. We'll eventually get there. Again, go back to your past concepts. Book value equals cost minus accumulated depreciation. Think back to our plant asset or property, plant, and equipment account. That's a true statement. So if we know that book value is $82,000, because we were given that, and cost is $166,000, we can solve for accumulated depreciation. We can just simply take the $166,000 minus $82,000 to solve for accumulated depreciation being $84,000. So now we can debit accumulated depreciation for $84,000. Another part of the journal entry is recording any gain or loss. A loss is an expense, so we debit it. Loss on sale of equipment, we debit it for $34,000. We're getting closer. We still haven't recorded cash. We know we received cash, so we need to debit it. So we can figure out our cash amount one of two ways. One way we can simply just say, you know what, I've got to have a balanced entry. If I credited equipment for $166,000 and so far I have two debits, if I subtract those, $84,000 and $34,000 from my one credit of $166,000, then cash has to have had an inflow of $48,000. That seems logical. We can also calculate it a different way, again going back to our concepts and saying a gain or loss on a sale of a plant asset is simply just our cash minus our book value. Again, plug in what we know and then figure out what we don't know. Our loss was $34,000. That's why I show this as a negative amount, $34,000. We don't know what our cash is, but we do know our book value is $82,000. Again, if we rearrange our factors here and use algebra, we can solve for the fact that cash must have been $48,000. So again, I can do this a couple of different ways, whatever is most comfortable to get the cash impact of $48,000. So our investing section, we're going to show an inflow of cash of $48,000. Keep in mind that's an investing section. Recall from our operating activities that the loss would show as an inflow of $34,000. Remember the logic was that the sale of the asset itself, the equipment, is going to show up as an inflow here, the full $48,000. Unfortunately, our loss showed up as an expense or a deduction from our net income. We need to counteract that by adding it to our operating section because we know the full $48,000 received is going to show up in our investing section. Okay, next one is B. We're going to pay $109,000 cash for a new truck. That's again a long-term asset. This is going to be an outflow of $109,000. So that one was a lot easier. Now we're going to get to C, where we're going to sell land costing $320,000 for $415,000 cash, yielding a gain of $95,000. Now you may start to read through here and go, oh no, not again. I've got $3 amounts. I'm going to have to go through this mess in order to figure out what the cash impact is. This one, they were nice. They gave you that information. The rest of the information is just simply a distractor. Some go for the gain, but keep in mind, we want to look at what is the cash impact. Land is a long-term asset, so it's definitely going to appear in this investing section. We're selling it. The $415,000 is going to be a cash inflow. So we can add that to our investing section. The next item D is long-term investments in stock. So it's not our shareholders' investment in our stock. We own stock in another company. It's long-term. It's sold for $92,100 cash, yielding a gain of $15,500. Now, I will tell you again, they give us the cash impact, so we could go through here and say, this is going to be another $92,100 added in. If I wanted to recreate the journal entry, which I wasn't necessarily required to, but again, going back to some of our past concepts, I could. Now, similar to when we sold equipment, we'd have to remove our long-term investment. The problem is they don't directly give us the cost of that long-term investment. But again, test out, go back to your concepts. You can figure that out. A gain or loss is simply your cash minus whatever you gave up, the book value of the cost of it. Again, we've got a gain of $15,500. We know that we received cash of $92,100. We don't know the cost of what we gave up, but we can use algebra to rearrange this and subtract the $15,500 from the $92,100 in order to get a cost of $76,600. Again, if we were recreating the journal entry, we would credit the asset long-term investment in stock for $76,600. Continuing to build our entry, the gain on sale of long-term investment would be credited for $15,500, and our debit to cash would be $92,100. Again, I didn't have to do this because they already gave us the cash amount, but I think it's a good thing for us to refresh some of these concepts. So cash received from sale of long-term investment, we're going to show an inflow of $92,100. Similar to what I talked about in A, but this was a loss and here's a gain. That gain is not showing up directly within our investing section. It sort of indirectly shows up within our cash flow, but that gain would be shown in our operating section as a deduction in order to not double dip. So we'll continue to look at these and total these up. Our net cash provided by investing activities, $48,000 inflow from the sale of equipment, an outflow for the purchase of a truck of $109,000 is subtracted out, an inflow of $415,000 from a sale of land, and an inflow from the sale of long-term investments of $92,100 gives us a net inflow of $446,100.